although the American Revolution and indeed a series of rebellions through the end of that century were all very much animated by the issue of taxation, then, as through much of American history, the United States has what I would characterize as a sort of weak and fragmented tax system, matching, as we've talked about throughout the class, a weak and fragmented state, something that defers to local governments, and in which public policy is very fragmented. Indeed, the growth of at least the national tax system comes in the United States largely in response to war. The quasi-war with France at the end of the 18th century, the War of 1812 with Great Britain, the Civil War, the Spanish-American War. Each of these ratchet up the need for federal revenues. Indeed, in the years between these wars or before them, almost all federal revenues come from a combination of what are called excise taxes, that is, taxes on specific goods and services like liquor or sugar or legal documents, or on tariffs, that is, taxes from goods entering the country. It's only in the 1860s, in response to the Civil War, that we get our first income tax system. And what occurs in each of these wars, and will occur again in response to World War I, is that the tax system created for the war is in large part sort of deconstructed after the war, or at least the rates are brought down dramatically. So it's a sort of ratcheting up and then a falling back, and a ratcheting up and a falling back. In the 1860s, the income tax was 3% on incomes over 10,000. 10,000 is pretty substantial income for 1860. So it's a minimal sort of intervention, at least, especially in contrast to today's income tax. Beginning in the late 19th century and running through the outbreak of the First World War, tax policy changes dramatically for a number of reasons. The first of which is easy to gauge from the previous history, is the federal government is garnering new responsibilities, particularly military responsibilities, and it needs a more dependable source of revenue. The second issue that's intruding is that the United States is drifting through the end of the 19th century, and particularly in the beginning of the 20th, towards more of a commitment to free trade, which it sees in the country's best interests as a sort of leading manufacturer. That threatens, of course, the principal source of federal revenue, which is the tariff, customs on incoming goods and services. And so for those reasons, you begin in the progressive era to get serious attention to an income tax, which finally arrives in its sort of modern form with the 16th Amendment to the Constitution, which is ratified in 1913. This introduces a new tax on business income. It gives the federal government the authority to tax lawful incomes as the law is originally written. That's later modified. They take the word lawful out so they can go after Al Capone during Prohibition. So unlawful income is taxable as well. And of course, the rates go up in response to the next great military emergency, World War I. Because you still have a relatively weak tax system, a lot of the financing of the war is done through essentially voluntary taxation or the sale of war bonds, and a lot is paid for simply by expanding the money supply, by the government printing more money in order to meet the war expenditures. Rates come down again after World War I. Despite the need for new revenues, the Republicans take over in 1920. Andrew Mellon, as Secretary of Treasury, is keen to get taxes down, and they're ground down through the 1920s, particularly at the higher marginal rates. And then, of course, comes the Great Depression. And as in so many areas of public policy we talked about in this class, the response to the Great Depression and alongside it World War II really transforms policy. The Depression does this on the tax front in really two fundamental ways. One is to create a whole range of new federal responsibilities. Think of all the work programs, the public work programs, all of the government spending, in response and recovery measures, the building of hydro dams in the Tennessee Valley, but also the systematic introduction of payroll taxes in order to pay for government programs like Social Security. So not only is the sort of federal income tax being ratcheted up in response to the Depression, but there's a new layer of taxation. The payroll taxes are being added on. Come World War II, which is a vastly more expensive undertaking than World War I had been, both in its length and its the sheer costs. But it's paid for roughly the same way, about a third by bonds, about a third by expanding the money supply, and about a third by taxation. The Revenue Act of 1942 invents, in a sense, the modern tax system in which ordinary wage earners see their taxes withheld at the source. And so come April 15th, you're not telling the government what you made last year. It already knows. You're just reconciling that account, paying them a little bit more or getting a little bit of a refund. The response to the Depression and the war then sort of creates the modern tax system. And as we come out of World War II, there's really no demobilization of federal responsibilities. Both political parties in the 1950s and 60s are fundamentally committed to a strong foreign policy, to foreign aid, to Social Security. That is, they have to keep revenues high. What emerges in the post-war era, really running through the present day, is a conviction not that the tax system should sort of come and go depending on federal responsibilities, but that it's here to stay and that it can be used for other purposes, like managing the growth of the economy, controlling inflation, or providing incentives and disincentives. And then, of course, this, of course, leads to the conviction, common in contemporary politics, that one way to stimulate the economy is by cutting taxes. This is done by Kennedy in the 1960s, and of course most famously by Ronald Reagan in the 1980s, and at the local level by the famous property tax revolt of the same era. So, this leaves us as a sort of general set of problems, or with a sort of general set of problems, which are really pretty consistent across the 20th century. One is a debate about what kind of taxes we have. That is, where do you get your revenue? From property, from sales taxes, from income taxes. All these, as Peter and Ed will trace, have different implications and different sorts of burdens. We get across this period a peculiarly American fascination with targeted taxes, with contributory financing for social programs, for example. There's an aversion in American political culture to paying for general obligations out of general revenues. Instead, let's have a road use tax and a toll and pay your own Medicare, pay your own Social Security, so that you have these discrete streams of tax revenue. We also see across this period, any time that there's a significant debate about taxes, this aversion to large government and a conviction that taxpayers are somehow picking up for those who are not contributing to the tax system. Again, this is why the American method of paying for Social Security has proven so popular, because you're paying for your own, you're not paying for somebody else's. Think how popular the old age Social Security system is because of the way it's paid for, and how unpopular through the mid-1990s welfare was because of the way in which it was paid for. Again, the way in which the taxes come in, the way in which they go out is of tremendous importance. There's also this sense, again, jumping from the 1930s to the present day, of a sense of the burden of taxes, either both on individuals, but also, of course, on business in terms of its ability to compete. There's an ongoing concern with the distribution of the tax burden, especially once it's accepted in the wake of World War II that we'll have a fairly steady stream of state, local, and federal revenues. this sort of hybrid tax system, in some respects, the concern shifts not from whether or not we have taxes, but who pays them. Are the rich paying? Are the poor paying? And the concern emerges for whether taxes are progressive or regressive, terms we'll talk about, or our guests will talk about in a little bit. I just want to end my sort of overview by just showing you a few graphs which gives you a sense of the way in which the system has changed across the 20th century. And Peter may have sort of different versions of these. Here's federal revenues by source, with the blue is individual income taxes, the red is corporate income taxes, the yellow is payroll, light blue is excise, and at the top are all the other taxes. And this gives you a sense of the growth over time. Although this looks like a very dramatic sort of spike, in fact, this is virtually identical curve to the growth of the economy or of gross national product over the same period. You get a better sense if we look at exactly the same data, but here summed as percentages, you can see the share of the tax system. So assuming every year comes out at 100%, you can see the reliance again on individual income taxes, a lessening reliance on business taxes, a widening reliance on payroll taxes as a source of federal revenue, and excise taxes, which of course are the foundation of the early tax system, declining in importance over time. And here again, this is not taxes, but actually government spending at the federal, state, and local level. And you can see, while it seems a sort of dramatic upslope, it in fact is tracking the growth of the economy. So GDP here is the red line. Here's the top rate for individual income taxes from the beginning of the income tax, which is 7% in 1913. And you can see that our current relatively low rates are somewhat of an exception. That in fact, for most of the 20th century, the top rate is above 50, in fact, above 60%. And then you get a slightly sort of finer view of the same thing if you look at the distribution across wage earners. So this top line is those at the very top, the top 1 out of 100 wage earners, or 1 out of 1,000. Highest earning 1% is the next, 20%, and so on. And you can see this is the source of, I don't know if you remember during the Bush tax cuts, of the sort of complaint that it was the middle class who were the lucky duckies who got to pay the bulk of the tax system. And you can see it's that sort of upper 20th percentile that is taking a higher share of the burden, while the taxes on the very poor and the very rich both declined over that period of time. So that gives you a sense of sort of big picture overview, how we've gotten to the tax system we have. I'm going to turn it over to the panel. Well, first we're going to hear from Peter Fisher of the Iowa Policy Project and the Urban Planning Department on campus, and then from Ed Wallace.